corporate finance practice problem using OneNote, stock split and stock dividend. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, and then down in the 1818 Stock Split and Stock Dividend tab. Also note, when using OneNote, look at the immersive reader. Our presentations up top will be down in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations then on down below. We're going to look at some problems related to stock split and stock dividend. As we do so, we want to think about it in context of a full balance sheet. And that'll give us a better picture of what is going on. Clearly, we're looking then at or concentrating on the equity section of the balance sheet, but it's useful to see the balance sheet and how we consider it to be in balance, how it will remain in balance after these things will be taking place. Also note that it's useful to consider the equity section as a whole in total, and then what's going to happen when we break it down to its components to a basically per share basis on different types of calculations. So notice that if we look at the assets up top, we got the assets totaling at the $1,335,000. Liabilities represent third-party or debtor claims to the assets, currently at the $348,000. And then if we look at the equity in total, we have then the $987,000. Now that equity in total could be calculated as the assets $1,335,000 minus the liabilities $348,000. So if you're thinking about a book basis, that $987,000 represents basically the owner's claim. It's kind of the book value of the company, what the company would be worth basically on a book value, or in other words, the owner's claim to the assets. Now remember, when you're thinking about the equity in total, it's kind of the same no matter what type of entity you're thinking about. In other words, sole proprietorship, partnership, and a corporation are similar in the terms of total equity. It gets confusing between the entities when you're then thinking about what the owner form takes place. Like, how are you going to break out the owner's claim amongst the owners? In a partnership, you would have actual capital accounts naming the owners. When you're looking at a corporation, the whole point is that you're not going to have a whole list of capital accounts naming the owners. Instead, we're going to be using fixed units so that we can have kind of standardized units that will represent ownership. Those units, of course, then can be traded. So when you're thinking about the equity section, then in breaking it out from its total here down to its components, we're not going to be breaking it out by owner, but by basically category. Two main categories we're going to take a look at then will be the common stock category and the capital in excess of par if we have a par value. And that represents basically the owner's investment into the company, meaning the company issues stock in order to generate capital, and that capital is going to be going into the common stock portion. Remember that the par value simply is representing a basically made up number. It's not a market value. It's not what we actually sold it for, but it gives us a nice even number to think about what's on the balance sheet in terms of the common stock. We get a nice even common stock here. If I was to see that common stock and know that the par value is $2, I could take the 200,000 divided by 2 and I can get to the number of shares quite easily. Whereas if I was to not have a par value and just record the stock for what we sold it for, we probably wouldn't come up with a nice even number because we would sell it for whatever we could sell it for at any given time. Therefore, the difference between what we actually received when issuing the stock and the par value is going to go into the capital in excess of par. So in essence, this 200 and this 200,000 and 100,000 represents the money that came from investors when we issued the stock to them. That is similar, if you talk about a partnership, to the owner putting money in initially in order to generate revenue. That's the money that, the investment from the owner. Now, in a corporation, you could have one stockholder that initially purchased the stock from the company and then sold it on the secondary market. So the owner that invested doesn't necessarily still own the stock, right? But still, this represents ownership, or basically investment from the owners. Whereas the retained earnings represents the earnings that have accumulated that have not yet been paid out. it's important to break out the retained earnings, because when we distribute the dividends back to the stockholders, we want to take it out of the earnings, because it should be treated as a dividend. In a publicly traded company or a C corporation, if you dip into basically the investments, it's not really a standard dividend anymore. You're giving back the initial investment. There could be differences in the tax impact and so on and so forth. So the retained earnings represents the income over the life of the company that has been generated that has not yet been paid back. So once again, just to recap on that, the total equity just represents kind of the book value of the company on a book basis. That is the owner's claim to the assets that we then need to break out in a corporation between the investments from the owner, which would be represented the common stock and the capital in excess of par, versus the income that had been generated from the company over the life of the company, which has not yet been given back to the owners in the form of dividends to the owner. So we're going to say that the stock price or the market price is going to be the $12. Remember that the market price is not something that's generated from the corporation, that's generated from the market. And if it's a publicly traded company, we would have the market price readily available to us. If it were not publicly traded, then it would be a little bit more difficult for us to kind of appraise or think about what the market price would be. Okay. So let's think about a 2-for-1 stock split. What would happen on a 2-for-1 stock split? Well, normally what you would think about here is that the assets and liabilities will basically remain the same. So a 2-for-1 stock split, you're going to have the same level up of the assets and liabilities. So same stock top part of basically the income statement. The change is going to be happening in the equity side of things. So on the equity side of things, if it's a split, then we're going to say the number of shares have now doubled. So we've got the 100,000 shares times 2 is now 200,000. So if an individual investor had 1 share, now they have 2 shares. All the shares that people have now doubled at that point in time. Now, in order to compensate for that, it's a nice easy process here. We could, if we have the par value, we could take the par value and divide it, by 2. So we take the $2 par value divided by 2. Now we have 1. So now we have the number of shares outstanding still now at 200,000 instead of 100,000. The par value has gone down to 1, however, resulting in the total common stock not changing at the 200,000. And so that's how we end up with the same kind of place. Everything else remains the same. No change to the capital in excess of par. No change to the retained earnings in that case. And of course, we're still in balance, having not changed the assets or the liabilities. Total equity remains the same. And simply everybody that owns a share then now has 2 shares at a par value that is half what it was before. Now, the par value isn't important to the actual shareholder. What is important is the market price, but you would expect then the market to have a similar kind of adjustment, right? You would expect the market price to reflect what is happening on the company and therefore reflect the change that would happen. So you would expect then, if you owned 1 share and there was a split, then you would own 2 shares, but the value on a market basis would reflect then basically be cut in half, generally, is what would be expected. But again, the market is separate than what happens within the company, but it should reflect what is being going on there. So then if we think about something different, a little bit more complicated, let's think about a situation where we have a stock dividend of 10%. So now it's not just a split, so it's a little bit more complicated, but we'll have similar scenario in that no change to the assets, no change to the liabilities. We're going to have then this change to the equity. So this is just a summary of what's going to happen. You can see basically the same concept here, meaning it's just going to be something internal to the equity. The total equity is going to be the same. And then we had the adjustments to the number of shares. The par value is still at 2 at this time. And then the capital in excess of par has changed and the retained earnings have changed. So this is a bit more complex of a scenario to figure out. We'll take a look at it down below. But before we do, remember that the end result is much the same, meaning the total equity, if you think of equity as a whole, doesn't change. We haven't done anything. We're gonna keep that the same, and therefore we're not going to be changing liabilities or assets. We're going to be changing the internal components of the equity section, including the shares, of course, that will be outstanding, as well as the capital in excess of par and the retained earnings. In this case, changing retained earnings, as we did not do with the split, because this is going to have kind of an impact. So we're assuming, we're actually giving value in this case to the shareholders in a similar way as if we were to give cash, and therefore we should be decreasing the accumulation of the earnings for the value that has been distributed. So let's calculate this out. We're going to say, okay, the number of new shares that are going out. We had 100,000 shares before. That was where we stood last time. And then we're saying it's going to be a 10% dividend. So 100,000 times 10% is 10,000. So we got 10,000 new shares that are going out. That means, of course, that the number of shares that are going to be out there is going to be the 100,000 plus the new shares of 10,000. That means that the shares that are now out there are going to be 110,000. 110,000 shares out there. Now we're going to say, well, what's going to be the common stock value? The common stock value, we're going to say, is the number of common shares after the dividend, which is 110,000. And then we're picking up the par value at 2. Now note what's happening. The par value didn't change as it did with the split. So we're still going to have the same par value of 2, but now we have 110,000 shares. So 2 times 110,000 means the common stock value is going to be at the 220,000. Then we're going to have an impact on the capital in excess of par. Looking at that calculation, that's going to be this number here. This is our old numbers. We had the market value, we're going to assume is 12 for our calculation. The par value is 2, which we already kind of considered when we had to make the adjustment in the common stock. So the difference between that 2 and the market value of 12 is going to be 10. And so then we're going to take that times the number of new shares, which is 10,000. That's going to give us an increase in the capital in excess of par of 100,000. So we're going to have an increase in the capital in excess of par of the 100,000. If we add that to the original amount, which was also 100,000, we now have then 200,000 for the capital in excess of par. There's also going to be a change in retained earnings because we're saying here that we're giving new value since it's a 10% split and not just, dividend instead of a 2-for-1 stock split. So we're going to say the starting balance was 687,000. 687,000. We got the number of new shares, 10,000 new shares going out. We're going to say for the purposes of our calculation that the market price is $12 per share. So we're giving out value not in terms of dollars, but in terms of stock of 120,000, which is the 10,000 times 12. So the amount that retained earnings is going to be reduced by is going to be the 120,000, similar to if we paid cash, because we're giving something of value, we're imagining here, but it's not cash, but we still should be decreasing the earnings that have been retained because we're giving the earnings out to the owners in the form of the dividend. So we got the retained earnings now at the 687,000 minus the 120, or the 567,000 in the dividends. So if we look at it then, this is where we stand in our equity section. So in other words, you can kind of think of it like this. You might want to start with the dividends. I did it the other way around, but we can view it reverse to summarize. The retained earnings, we're imagining what's going to happen to retained earnings. Well, we're giving 10,000 new shares out at $12. So there's going to be a change of distribution, we're imagining, from that of the 120,000 that's going to come out of retained earnings for the dividend, the value that's going out. That's why this went down to the 567,000. Now we're going to have to balance that out, not by changing the assets or liabilities, but something in equity, which is going to be the common stock and the capital in excess of par, which is going to be the difference. Now, part of that's going to be taken care of if we have a par value, because the shares have now gone up to 110,000. Par value has not changed. So $2 of that 12,000 adjustment on that 10,000 new shares is going to be taken into account with the common stock itself. The difference, meaning the $12 that we took into consideration times the 10,000 shares minus the 2, leaves us with that we took into consideration with the retained earnings. The retained earnings, we had 12 times the 10,000, and now we have 2 times the 10,000 to balance that out. The other 10 times the 10,000 is going to have to be the change in the capital in excess of par. So we're going to adjust the capital in excess of par, which is our calculation up here of the $10 times the 10,000, which is that 100,000 change, plus the prior 100,000 to the 200,000. And that's how the adjustment can be taken place. You can basically say, we had an adjustment decreasing the retained earnings down here of the market value, 12,000, times the new shares, 10,000. And then it was split up, the other side of it split up between the common stock and the capital in excess of par, the common stock being impacted by the par value times the 10,000 shares, the difference then being the remaining $10 of the $12 times the 10,000 shares, which would be adjusting the capital in excess of par. Bottom line then, same result, is that we are at the same equity, so we're still saying no change to the total ownership as a whole. However, we do have some changes that impacted the distribution in terms of the shares, the capital in excess of par, and the retained earnings.